We talk about technical analysis, we cannot avoid to talk about support and resistance because they are the most used concepts in forex trading. The terms support and resistance were created back in the early 1900s in the stock market. Support occurs when traders begin buying, supporting a product as it was falling. Conversely, resistance occurs when traders feel prices are getting too high or expensive and they resist buying at that price. So support and resistance are price levels or range of prices that a currency pair doesn't often go over or under. The first important thing you should notice is that support and resistance are not exact numbers, they are levels or range of prices. In this example, we can see a support. The price clearly struggles to go under 1.0850. So we say that 1.0850 is a support level. If you take a closer look, you can see that the price doesn't stop at 1.0850 and then it goes up. It goes to 1.0852 or 1.0849. So we identify 1.0850 as an area, but it doesn't mean that the price goes exactly to 1.0850 and then it goes up. Here we have a resistance instead. The price reaches 3 times 1.0950 area, but then it goes back. So you can notice that support and resistance are like a wall. When the price arrives there, it looks that it hits the wall and reverses. Why does it happen? Every market price is made by supply and demand levels. A support is simply an area where the price starts to be appealing and this increases the demand for that currency, pushing the price up. With the same logic, a resistance is an area where the price starts to be seen too high and the demand for that currency decreases, pushing the price down. And the trend is simply the direction of the market, so which way the currency pair is moving. But when you have a look at the chart, the first thing that you notice is that there is no straight line to help you to identify any direction. You never see something like this, but you can see something like this. Even if it is quite obvious that the price is going up, how can you say that? Let's analyze this example. You need to have a look at the highs and lows that are formed on the market. In this example, we start from here and the price goes up before having a change of direction. So just focusing on these 3 points, we can say that the first one is the first low. Then the price reaches a high and then it goes back to form a second low. Then it starts to go up again and we have a new high. And then at the end we have the price that forms the third low. Now, are these highs and lows growing? Yes, the second low has a higher price than the first one, and the third low has a higher price than the second one. The same thing for the highs. So you can say that the price is not going up as a straight line, but overall, the price is going up because new highs and new lows are higher than the previous ones. This concept defines an uptrend. When new highs and new lows are always lower than the previous ones, we have a downtrend. We also have a third type of trend, that is the situation when the price is not going up, but it's not even going down. This trend is called sideways trend. In this situation, the price moves in a range that is defined by a support at the bottom and a resistance at the top.